well, thank you for joining us today for the second webinar in the Bernstein Quant Conference called New Observations on Crowding and Selectivity Theory. And I have with me today Ludwig Chincarini from University of San Francisco. He's a professor of finance there at the School of Management, and he's also the director of quantitative strategies for the United States Commodity Fund Investments, with over 15 years of experience in the financial industry, specializing in portfolio management, quantitative equity management, and derivatives. He also works with an angel group to help startup companies. He's the author of two very important books, a classic in the field of portfolio management entitled Quantitative Equity Portfolio Management, and of course his book on crowding, The Crisis of Crowding, which detailed the idea of crowding as an alternative view of one of the causes of the financial crisis. So he received his PhD from MIT and a BA from UC Berkeley. Now, if you have any questions while this presentation is going on, when you registered, the email that you got with the registration link should have had also a link to Pigeonhole. And you can click that link and then type any questions you like, and you can vote on questions that have already been asked. And we will get to as many questions as we can at the end of the presentation. So with that, I will turn it over to Ludwig.
Thank you, Anne. Hello, everyone. Welcome. I can't see all of you, but nevertheless, let me share my screen. Okay, so hopefully this works. Can everyone see my screen?
Yes.
Okay, great. Okay, welcome. So I'm going to talk about just a little bit of crowding today, and mainly selectivity theory. And so I want to thank Anne for inviting me, and I want to thank Sanford Bernstein. And I also want to tell people, if you're aware of my QEPM book, we're getting a new version out in 2021, so please look out for it. You might want to keep it on the shelf or give it to your junior analysts so they get a sniff of the quantitative world. Okay, great. The crowding idea is spreading. As you know, Anne works a lot on this. There's a lot of new academic literature on it, and it's really been increasing in the last 7 years. Academics tend to ignore new good ideas, right? So at first, a lot of this good research came from practitioners like Anne and other outfits, other companies. But also the practitioner research is exploding as well, and it's really great stuff to see. I'm not going to talk about all that today, but you can go to this link, and I'm sure we can share with you the slides. I'm happy to email them to you. But if you click this link, there are tons of slides that have the latest research, references, and all kinds of things that could be interesting for you. Okay. So also, when I title the beginning of this New Observations on Crowding, I want to be a little bit humble here, which is I don't have a lot to talk about that you might not already know. And the main thing that I have in this presentation is the latest research and some of the interesting research that has come about. And I'm not going to go through that because I think some of you would be bored by that, but it is in Appendix A of this presentation, all those summaries. And so please go ahead and read that later, but I won't talk about that today. And again, you can get a copy from any of us. Okay, so these are the stories that all of you are reading on crowding. Active managers had worst stumble in 2 years last month. The worry now is that long U.S. tech is the crowded space. And this is from another bank, but you can see they're coming up with things that you know about already, that there seems to be a crowding in tech and growth stocks. Okay. This is from Sanford Bernstein, and this is one of their latest reports. And I sorted this by most crowded stocks in the technology sector and the largest companies. So these are the 10 largest companies, but the most crowded in the technology sector in the United States, okay? And when you look at this list, perhaps a lot of you are saying, very obvious. Maybe some are new. Maybe Accenture, for example, wasn't on your list. But this is from the research of Bernstein, and I simply sorted it out. And Apple, of course, is there at the top. In Europe, the most crowded tech stocks in Europe, again, same story. I've sorted it by market cap. These are the companies in Europe that seem to be the most crowded. Now, I should mention the crowding measure is not necessarily related to market cap. That is the definition by Sanford Bernstein, but I sorted by market cap just so we could see who are the big companies that are crowded. And everyone's familiar with this story as well, the value and size problem. Now, whether it's crowding or not, it's always hard to tell. It requires more research, but there is some belief that it is crowding. And you can see here what everyone knows, that essentially if you look at what I have here plotted, the yellow line, the gray line, this here is the value factor of Fama and French. And you can see that in the last 2 years, it's gone down roughly 40%. So absolutely slaughtered. If you look at the size factor as well, that's been slaughtered, okay? So again, is this crowding? Perhaps. And here's a similar view of it for people who don't care about factors. Russell value versus growth. Even in the last 2 years, there's a 108% difference in returns, which, if you think about it, sounds very extreme. Okay, here's another way, though, to look at this, and I did this. What I did here is I took some of these factors from major providers, everywhere from MSCI factors. Now they have a nice factor database, research affiliates, Fama French, AQR, a lot of companies that are producing factors on a regular basis. And what I did is I tried to run a regression to understand what is the alpha of these factors, okay? And so again, what is the excess performance over the market of these factors when you account for the risk inherent in the factor? And what you see here, it's hard to see because I plotted it, but I put all four in a graph. But since 2005, generally the alphas of these strategies are declining, okay? The momentum one is a little strange. Obviously, everyone remembers 2009 when momentum took a nosedive. But the other factors, the alphas, are on a decline. And this is suggestive of crowding, that there's just been a packing into the space. Okay, these, by the way, the factors are value, momentum, quality, this new quality variable, which again, I'm always worried that there's data mining involved here. But nevertheless, quality has become popular. And then this last one is the size factor, okay? And again, I'm happy to show that to people if you want to see how I did that. Okay. Gold has been mentioned as a crowded area. And again, how do you know? You have to do more work. But one thing that's interesting about gold is all the money that's flowing into gold. We know gold could be an inflation hedge. We know gold could be a safety valve when we think the markets are going to collapse or we might have a recession. But we also see this massive explosion in AUM, which makes you think pressure is being put on gold prices. Okay, the other thing that I think all of us have to keep an eye on, and I think we all do, and it's hard to do, but is the changing appetite of investors, because crowding can also be related to the taste of individuals. And so one of the things that we read about a lot in the news, and it still hasn't been sorted out very well, I think, but is the fact that we have these new generations of investors that like to hold Apple, Amazon, Microsoft, Tesla, and Facebook. And so that alone also is changing the landscape. And maybe some of you have figured it out better for your own investment vehicles, but it is something to keep an eye on because it is distorting the way markets are normally behaving. And so something to be aware of. Okay, so now as I gave you a very basic intro to crowding, which I think was fairly obvious, and that's fine. But now I want to move to passive crowding and active management, okay? So some people are worried that there's been a big move to passive management, and this has been going on for many years. And I took this graph from Bernstein, actually. By the way, I should say Inigo, who's a Bernstein quant, is excellent. I want to just say that. I don't know if he's on this call, but the whole group does really good research. And I just want to say that because it's really nice research. So this graph I stole from one of his or their papers, the groups. And it just simply shows that maybe as passive management grows, there could be more correlation between the stocks that they're buying in these market cap passive portfolios. So there may be some crowding going on. And in fact, if you look at the growth in passive management, it's been growing. We all know that. This is not a surprise. But there's a nice graph. Now, what is there crowding? This is a complicated issue, and even Inigo and his team touched on this, which is, what does passive mean? How do you count smart beta, for example? Is smart beta passive? And if it is, how does it net out? For example, there's an article that is published, and it's in my references at the end, where someone said, because there's so many smart beta strategies, do they null each other out? Meaning, does one strategy actually nullify the other strategy so you don't really have crowding? And they found that there is some of that. So again, how do you count passive is going to be a difficult issue. But I'm going to abstract for that for a little bit. And then the other thing is, we all know active managers can crowd, especially quants. Too few good ideas, chasing similar stuff, copycats, et cetera, et cetera, et cetera. Okay, so we could have crowding on one extreme or the other. And so this is sort of my segue slowly into this selectivity theory that I'm going to talk about today. So I'm going to create a simple world. There's M managers with a total of V dollars to invest in a total of N stocks. Okay, very simplified world. Each manager can put VI dollars into the markets, and each manager chooses the weights of the stocks in their portfolio. Okay, and for simplicity, we're going to assume passive managers equal weight all the stocks. This is just for simplicity, but of course, in the real world, they're doing more market cap. Let's also assume only half of the stocks are good, half of the stocks are bad. Okay, we'll make that assumption. Is that true? Well, actually, it's not that far off, but let's abstract a little bit. So the question becomes, how do active managers build their portfolios? Now, most of the world, it's mean variance. You do tracking error with respect to your passive benchmark. You try to outperform, especially an enhanced index manager, and that's how you do it. We've been doing that for years. The other thing they could do is pick a fraction of stocks that they think will have the highest return. So pick 10, pick 15. Now, in this simple thing this exposition I'm doing, I'm not going to talk about how to model prices, because obviously crowding can affect prices, but I'm going to abstract for that a little bit. And I'm just going to talk about what they might be thinking. One thing is, if they all move at the same time, they might want to think about the game theoretic aspects if they're all going into the same stock and adjust for that, okay? And there is no model for that, but I think that's another area where research should go. Okay, so let's say these active managers are very good at predicting winners, okay? So the active managers can predict winners perfectly and the magnitude of the winner. What should they do? In the sequential action game, meaning one manager chooses, then the next, then the next, the next, which is not really the real world. But then in this case, they would basically buy till a stock got saturated or crowded, and then go to the next best stock, the next best stock, the next. Okay, and that's one way. In the simultaneous game move, they would start counting for what everyone would do and try to adjust the portfolio so that crowding's minimized. Okay, that's one version. Let's now go to another version. They can predict winners, so the active managers know what are good stocks, but they don't know how good they are. Okay, so what should they do then? Well, one idea is just buy all the good stocks, pick a diversified set of winners, but they don't know what all the good stocks is. We know that they they're good at picking, but they may not know every good stock. So the other choice is just pick 50% of the stocks. Get all winners if they know the winners. And another way is going back to mean variance. So reduce your tracking error and pick the best stocks with your alphas or whatever you're using. Okay. Okay, so is there another way to think about this? Okay, so now I'm going to talk about selectivity theory, which was just published by Bolshakov and Chincarini just recently, and that link will get you the article, but I also can send it to you. And again, now we're moving away from crowding. I want to talk about this new idea, and let's leave crowding on the side for a second, okay? So there are some assumptions in this model. And some of these assumptions are new to people and difficult to swallow, but let's all behave a little abstractly today and just kind of think differently. So let's suppose in any given index, there's 50% winners, 50% losers, okay? Yes, it's a little bit simplistic, but also not that unrealistic. Let's assume also that a stock either performs or doesn't perform, okay? It doesn't matter that, for example, Netflix does, 20,000%. It just matters that Netflix beats the market, beats the average stock. Assumption 3, a portfolio manager's constant skill lies in the probability to pick a winner versus a loser. So there's several assumptions in here, which, again, we can talk about another time as to the realistic of them, how realistic they are. But what we're going to assume is an active manager has skill. An active manager has skill, meaning they can pick winners more often than they pick losers. Not perfectly. So they're not perfect. They can, just on average, they pick winners more than they pick losers, okay? Think of it as a coin flip. Coin flip would be 50-50. They're better than a coin flip, okay? And the other assumption here is that their skill never dies. So an active manager has skill always, okay? And again, we could argue on that assumption, but that's what I'm going to assume for now. And assumption 4 is the benchmark and portfolio are equally weighted. This turns out to be not important at all, but it just makes things simple. Okay. So because this is new stuff, I have to introduce a little notation. So omega is going to be the thing that tells you whether the active manager is good or not, okay? So essentially when omega is greater than 1, as you can see here, omega, it means the manager, the active manager, is more likely to pick a winner than a loser. That's what it means. And by the way, hopefully that's true, because otherwise, you want to be in a different business. So to give you an idea of how you map omega to probabilities, omega of 1.1, for example, is a manager that the probability of picking the first stock as a winner is 0.52 or 52%. So it's not crazy. Omega 1.1 is not a crazy number. It just means the manager, on average, is better at picking winners than a random coin flip. Okay, so it's very, I would say, reasonable. So there's two ways now in this theoretical model that managers can pick stocks. One is called the bulk selection method, and one is called the sequential selection method. What's the difference? Bulk selection means the manager says, I'm going to pick 400 stocks, and they apply the model and grab the 400. The sequential selection method, they pick one, then pick another, then pick another, then pick another. Now, what's the real world? Well, it's probably somewhere in between. But nevertheless, these are the two different methods that lead to the theoretical results. So I want to talk about these two. Okay, so these are two methods to pick stocks. So it turns out that the bulk selection method will be driven by what's known as the Fisher non-central hypogeometric distribution. If you haven't heard of it, good, because it's not mentioned almost anywhere, okay? So even statistics people are saying, I haven't heard of it. So it's a very rare distribution that isn't talked about much. The sequential selection method, where the manager picks one by one, that one is driven by what's called the Wallenius non-central hypergeometric distribution. And again, You don't have to worry about all that. And if you haven't heard of it, good news. And by the way, I think the last time someone spoke of this was in a 1963 thesis at Stanford University.
How are you?
I think we're okay now. So let's do a simple example to understand what the math is. And again, don't get too bogged down in this. Let's say we have a benchmark of 10 stocks, 5 good and 5 bad. What's the probability of picking 3 good stocks in a portfolio? Now, anyone who's taken statistics remembers all this, except here it's different. This isn't a hypergeometric distribution. It's not a binomial distribution. This is different. And the reason is the manager has skill. So in the bulk selection method, where they pick a big bunch of stocks at once, what we have is that if they have no skill, the probability of getting 3 good stocks would be 39.68%. This just comes from the distribution. What about if they have skill? 1.1, which we gave you an example what it is, then the probability of getting 3 good would be 41.49, and naturally that's going to be higher. Okay? To get that actual probability, it's related to combinatorics, and I don't want to go through this with everyone here because it may take some time, but you can compute the probability of getting those 3 good stocks by the combinations when you pick 3 from 10, and you can also compute all the other possibilities in the denominator to get the probability, okay? And when you do that, you find here, if you look here, this is the number of good stocks on the left-hand side. Can people see my little mouse flying around? Do you see my mouse?
Yes, we can see.
Okay, great. So these are the number of good stocks that you pick. So remember, you're picking 5 out of 10, and this is the probability that you actually get that many. So the probability of getting 0 good stocks when you pick 5 out of 10 is very low, 0.31%. The most likely is you get 3 good stocks, 41.49%. Okay. So now once you have this whole computation from this non-central Fisher distribution, you can ask things like, what's the probability of getting more good stocks than bad stocks out of 5? Well, that means 3, 4, or 5. So if you pick 5 and you have 3, 4, or 5 good, you've picked more good stocks than bad stocks. And that's simply summing up the probabilities right here, that you're going to have 3, 4, or 5. Okay, and this is similar to other statistical techniques like binomial, whatever you might use. It's just the actual numbers are different because of the way we have a skill in the manager's picking. The result is 53.4%. So the probability that the manager has more good stocks than bad stocks is 53.4%, which makes sense because they're supposed to be skilled. Okay, so let's keep moving. We just did an example of bulk selection. Sequential selection is a little more complicated because there's path dependency, meaning you pick a stock, you've removed it from the universe, and now the distribution inside has changed. So you need to look at all the different paths. And again, I don't want to spend too much time on this because we will just get lost in the details. So let's just look at it briefly. What I mean by paths is you could pick one. The first stock could be a good stock. The first stock could also be a bad stock. Okay, 1 means you got a good one. 0 means you got a bad one. So you need to compute all the paths possible. So you could pick a good one on the first try, a good one on the second try, a good one on the third try. Again, very unlikely, 4%. But that is one path. And there's all these paths that will give you 3 good stocks in a portfolio of 5. And once you do the math, you realize if you add all of these up, you will get the probability of getting 3 good stocks, which is 41.98%, slightly different than the bulk selection method, okay? Because, again, you're taking a stock and you're changing the distribution. If you do the similar steps that we did for the bulk selection method, the probability of getting at least more good stocks than bad stocks turns out to be 54.39%. How do you get that number? Well, you have to do this whole thing for 3 stocks, which we did here, for 4 stocks, which I don't show, and for 5 stocks, okay? And so once you do that, you add up the probabilities, and you find that picking 3 good stocks, more good stocks than bad stocks is 54%. Okay. And again, does that make sense? Yes, because the manager has skill. And it's slightly higher than the bulk selection method. Okay. Where are we going with all this? If you believe these assumptions or you think they're interesting to think about, then we make a couple more assumptions. The first is that the good stocks give you a 10% return. The bad stocks give you a negative 10% return. You don't need that particular number, and we relax that in other work, and it works as well. But we're just doing that to make the problem tractable, okay? If you do that, what we find is you can express the expected return and the standard deviation of the portfolio just like we know from the way we manage money. And so it turns out that this is the formula. This is the expected return of a portfolio where P star is the number of good stocks, the average number of good stocks you get when you draw from one of these distributions, okay? And below here is the standard deviation of the same portfolio. And so this is turning this strange world that we're in, you know, this bulk and sequential selection with omega, into the world that we all understand, expected return and standard deviation. And when I do that, you can see where I'm going next. I'm going to compute the information ratio, okay, which is just expected return divided by standard deviation. Okay, so I'm going to compute the information ratio as this, okay? Now, you might be asking, what happened to the benchmark return? Well, it turns out in this very specific example we're doing, the benchmark return is 0. So it is technically expected return of the portfolio minus expected return of the benchmark over the standard deviation of the benchmark portfolio minus the benchmark, or tracking error, but it's the same as this in this particular case. So this is what we're going to try to maximize, which is our information ratio. And we also look at the downside information ratio, and the reason for that is because it turns out that we discovered that especially in cases of extremely good active management, the information ratio breaks down, okay, which is interesting in itself, but it's not really the primary purpose of the paper. Sorry that there's a lot of info, but I'm going to continue and try to make sure I keep it on time. Okay, so let's do an example. Suppose you have 500 stocks in the universe. For example, let's say your benchmark is the S&P 500. There are 250 good stocks, 250 bad stocks, okay? Your omega is 1.1, so the active manager has skill. What is the optimal selectivity ratio? It turns out that it's 50% for the bulk selection method. So you see here, this is the manager for different omegas. Let's look at omega 1.1. This is the selectivity ratio, proportion of stocks the manager chooses out of the 500. This is the information ratio. And what you see is, as the manager buys more and more stocks, the information ratio keeps going up until 50%, at which it declines. So what does this say? If you believe that we live in a bulk selection, Fisher non-central hypergeometric world, the manager, the active manager that has skill, this is a very good manager, should be picking 50% of the universe. Okay? That's pretty startling to think about. Just think about that for a second. That's startling. Now, you may not agree with the assumptions, but that's a startling result. What happens when we go to the sequential method? Now, here's the difference. The manager picks a stock, puts it in the portfolio, then goes and picks another one. Here, things change a little bit. Same graph, but now the manager's IR keeps increasing until the manager gets to 80% selectivity. Okay? So in this, if you believe the world is more sequential, then what it says is the manager, and remember, this is an active manager. That's what's, a little bit shocking about this, should pick 80% of the benchmark in the portfolio. Now, it's going to be different than the benchmark. Obviously, this manager is going to be stacked with winners, but it's still a lot more than you typically think of when you think of active management. Okay, so that's the result. So where do we go next? how do more stocks affect the benchmark? You might affect the results. They don't. So the more stocks you have, if your benchmark is the Russell 2000, the only difference is you hold more stocks and your information ratios are higher. That's the only difference, okay, in the theoretical model. There's a lot of other characteristics. For example, you can show, I'm just going to go to characteristic 2, you can show that as your skill level stays the same, but you get a larger universe, the information ratio increases by approximately square root of M over N. What is M? The number of stocks in the universe. N is the number of stocks they're picking. So that's an interesting result, actually. It's kind of a peculiar but interesting result. And there are other characteristics which I'm happy to give you the paper to look at, but I don't want to take away from the main points here. Okay. One thing we did find is that the information ratio broke down for very high skill levels, okay? And a lot of you are already familiar with the problems with information ratio or standard deviation when returns are skewed. So this is something that is interesting, but not, again, the point of the paper, but I show it anyway. What happens when the skill is really high, you see this blue line? The information ratio just breaks down. It doesn't make any sense anymore. And this is really interesting only because we found it by really creating this world where there was extremely good managers. You know, things that we don't see in the real world is another way of saying it. And so when that happens, you really have to move to the downside information ratio. Okay, and that still makes sense. And rather than explain that, the only thing I will say is that with the sequential method, as the manager becomes extremely skilled, the optimal ratio moves away from 80%. So that's an interesting thing, although the skill levels we're talking about are not real world skill levels. This would be as if God came down to manage a portfolio, that kind of skill level. Okay, so we had a lot of assumptions in the model when we built this model, and some of you may think reasonable, some of you may think not reasonable. And so I don't want to spend a lot of time on that because it's another paper, but in this other paper, which is called Enhanced Indexing and Selectivity Theory, and I'm happy to send you that paper if you email me. Any of you can email me. My email is either available for Sanford Bernstein or it's on the web. I will send it to you. But let me summarize. Most of the assumptions don't matter if you let them go. So assumptions 1, 2, and 4 essentially don't change any of the results, even if you let them go. The only thing that does change, I'll just speak about one so we're not here too long, is if you believe that active manager has skill only for a certain amount of time and then it disappears. So an example, suppose the active manager only has skill for 30% of the universe, and then literally the skill disappears completely, which again, you could argue is not realistic either. But let's say that's true. Then, of course, you don't want to go to 80% or 50% holdings of the benchmark because your skill's gone. So in that case, it would be where your skill disappears, but that also is a very unrealistic assumption. The other one to mention is, what if a manager has skill, but as they pick more stocks, the skill declines? That's okay. Even if the skill declines as they pick stocks, you still want to hold 50% or 80% or in between. Remember, the real world is somewhere in between these, bulk selection and sequential selection. So that's interesting, that steadily declining, that won't change it. And so we do a lot of different variations because at the end of the day, we're trying to understand, what does this model really mean for active management? Okay. And I'm happy to send the paper. So the summary, though, is relaxing a lot of the assumptions doesn't change some of the interesting results from this theoretical abstraction. Okay. I've just got a few minutes before we do Q&A. So I'm going to move back to crowding, okay? And again, what am I trying to do here? I want to talk about a world where we have active and passive. So here, I created this simple model. And now let's assume that psi, I would do the Greek symbol, but it takes a long time in PowerPoint. Psi of the dollars are active with omega greater than 1. So we have a portion of the investment world is active managers, and they have a omega greater than 1. So they're these good managers, okay? And then we have beta percent of the world are active managers with omega equals 1. What does that mean? They're active managers. They think they're good, but they're not, okay? Or they're as good as a coin flip. So they're random noise. And then we have the rest of the universe is passive managers, okay? So we're going to assume that index managers invest equally in each stock, okay? Again, we created an equal weight world, but really it's probably a market cap world. Uninformed managers do the same because they're random. So they're basically like equal weight. They think they're good, but it's random across the stocks. So active managers, of course, in the real world, as a lot of you know, can do whatever you want. But we're going to assume for a moment that they are all the same. In other words, they have the same information, they behave the same way, and they can pick, the only thing they can pick is how many stocks they hold of the universe. Okay, that's the only choice they have. If you do that, it turns out, and I'm happy to share this with someone, but the more details, because I jumped right to it turns out that the active crowding is given by this ratio here, right here. Okay, and so I'm going to do an example of what that means, and perhaps it's fairly obvious. With psi equals 1, so psi equals 1 means you have all active managers, okay? You'll have infinite active crowding, and that's quite obvious. With psi equals 0, you'll have infinite passive crowding. Okay, so it's the other side. You have all crowding on the other side. If you assume that 20% of the investment universe is run by active managers, and you can change that number, but I just assumed it for simplicity, and maybe it's not so far off. With active at 10% selectivity, so all these active managers are 10% selectivity, the crowding is 2.5. If they go to 80%, the crowding drops tremendously, okay? Which I guess is fairly obvious, but at least we put it in a somewhat of a model. So the idea is, let me not try to sell this too much. So we began by talking about crowding. We then talked about selectivity theory, which is separate from crowding. It's a separate idea. It's a new idea, okay? But then I wanted to go back to crowding and say, let's say the world did behave like selectivity theory says. What would it do to crowding? And the main result is that it would actually reduce crowding in active management, okay? So that was the purpose of coming back to this selectivity theory. So selectivity theory, whether you believe it or not, one nice aspect is that it would reduce crowding in active management. That's one of the nice aspects of it. Okay, what do we got next? So the crowding model I presented today obviously is very simplistic and needs more work, and I hope to work on that as well. And if anyone's interested, please email or call. And for selectivity theory, we're currently working on some really cool things because right now we have a theoretical paper. We then have a more practical simulation paper that I can send you. It's not published yet. And now we're working on how to figure out how to make it very practical for everyday people, for everyday investment managers, for everyday active managers, for everyday CIOs, for example. And so that is a challenge because we want to make it easy for people to use and understand. And we're working on that. So I'm happy to share that as well, but it's still not done. So that's where we are there. Here are some references if anyone wants. I'm wrapping up here. These are some references. And like I said, I hate to do a plug for the book, but QEPM is coming out, a new edition. So please use that, and please look for it in 2021. And the first two papers are the papers on selectivity theory. And the fourth book, of course, is the crowding book. And if you haven't read that, get it just for kicks and giggles. And thank you very much. I think that's a great place to stop.
Thank you, Professor. That was awesome. Very helpful. Thank you. So, if you have a question, just a reminder, click your link to Pigeonhole and type in your question. And I would say, there's some interest in what kind of feedback you have gotten on this research, given that this seems to be, in contrast to the trends that are happening in the industry relative to idiosyncratic alpha, and the wide gulf between, fundamental stock picker type funds, which tend to own very few stocks, sometimes 20 stocks, 30 stocks, versus quant funds where, they, own 100 stocks, right? And so the trend has been, in order to produce, it doesn't mean that just because you own a few stocks, you necessarily have idiosyncratic alpha, but, there has been research showing that in order to get idiosyncratic alpha, you probably need to have a more concentrated portfolio. So what do you think, is going to be the feedback that you're going to get or that you have gotten already?
Good question. Haven't got a lot of feedback already because it's new, and so I haven't got a lot of feedback. So thank you. So but your questions are great questions, and it's true. In our world that we've created, we're assuming that these managers have this constant skill going forward, and so that's part of the reason you need to continue picking more. My guess with a lot of these fundamental managers is that the reason that they stop after 20 stocks is perhaps, I don't know, but perhaps because they don't, a way of thinking about this is they don't have the time or the ability to go and research many more stocks. Maybe there's a limit on the time. And so you could consider the limit on the time something like an alpha saturation. In other words, the world saturates for them. And we find that there's one simulation where we find that even in that case, there's a better alternative. One alternative is, so how do I say this? One alternative is that particular fund will probably continue to choose very few stocks. But then one step back, suppose you're the fund of funds or the CIO. The CIO should pick many of those funds, because the CIO doesn't have a limitation. So the CIO might look at that and say, okay, they have a limitation, but if I get 5 or 10 of those funds together, I still get to my 50 to 80% selectivity, which could be optimal, and yet they don't have to do things they can't do. So that's my quick answer for that. But I'll think more about it. I mean, this is a good question. So I'll think more about it.
Thank you. Okay, so another question, how does the ideal fraction of stocks change if maximizing return as opposed to IR is the metric to be optimized?
That's a great question. Offhand, I don't know, but I'm going to guess. I don't think that's what you'd want to maximize, but that is a good question. I'm trying to think. I don't remember actually what it does. Let me think for a second what it should do. I don't know offhand, but I think I don't want to say anything. I don't know that offhand. My guess, but I can get back to whoever wrote the question. Just email me. I don't. So let me try to be a little defensive. I don't know why you'd want to do that, right? Because the world's judged by risk and return. But I'm trying to think what does happen. I don't want to say something that's incorrect right now. But again, I don't know why you'd want to do that. But whoever asked the question, happy to email me, and I will let you know for sure what happens there.
Sure. Could you elaborate a little bit more on your definition of crowding?
Yes, just 1 second. So there's various definitions, okay? In this example that I gave you today, I gave you a very, I would say, a very crude definition because I was trying to do a general model, right? I was trying to do a very simple model to illustrate an idea. And what I mean by crude is my measure today was simply the amount of assets in a particular investment, okay? Which is, by the way, it is one of the metrics people use, but it's a very crude unsophisticated method, but I was trying to illustrate in a very simple example. So today's crowding measure for the purposes I was using was assets, the percent of assets in a certain strategy. So for example, if people are doing the value strategy, okay, it would be the equivalent of saying 80% of the assets in the world are in value. That's one way that what I was using today. Now, there are many other measures that I and others have come up with that are in my presentations on my website. You're happy to go there, or even in the book, Crisis of Crowding has some measures, okay? But now, if I don't know if that's what you were asking, those are much better methods. And the key in crowding people are trying to unwind. And by the way, the reason there's so many measures is because we still haven't cracked the nut perfectly. You know, Anne, for example, does a lot of good research at Stanford. They do very sophisticated ways. They have various metrics to measure crowding. The academic literature has various methods to measure crowding. I have several papers which try to measure crowding, but we're still not settled on one way. But the general idea is when a space has been crowded, an investment space has a saturation of investors of a particular type in relative to the liquidity in that space. That's sort of what is sort of the people are driving at. And liquidity in the space can be measured many ways. One of the ways, though, is how many people are on the other side of the trade. And we try to measure that different ways, but essentially that's the key distinction of crowding, the saturation versus the liquidity. So I don't know if, but go to my website, all my presentations, they give tons of definitions. And I'm sure, by the way, if you receive Anne's letters, she has stuff there too that she can.
Okay. Another question that just came in: by selecting 80% of the benchmark, it seems that simplistically the model is consistent with the arguments for passive. Would you agree or disagree? And how should we think about this? Meaning, if you own 80% benchmark, is that just an enhanced index fund?
So that's a great question. So first, couple things to say there. First, the model's built on certain assumptions, so one should look, do I believe I fall within those assumptions? But having gone past that, the second thing to remember is it's not just 80%. There's two ways to pick the stocks. One is bulk selection, where you pick everything at once. And the other one is you sequentially buy your stocks. And those have different results. So those results go from 50% to 80%. Now, one could argue that 50% isn't really passive or even enhanced passive. I mean, you could call it that, but essentially you have 50% of the universe. So the real area is 50 to 80. It's not just 80. 80 is the extreme right. And it sounds like a political comment. No, but I'm joking. So 80 is extreme right and 50 is extreme left. And so it's somewhere there. Remember, every theory, you don't want to follow it like a recipe book, but it's in between there. And so that's the comment. So I'd say that it's not really all passive, because you could be, maybe you're at the 55. The other thing to mention is that passive crowding is very different, because passive crowding is market cap weighted, usually the entire universe. And so in the selectivity theory, we're doing equal weighted. You're picking equal weighted. And so even if you do 80% equal weighted, this is different than 100% market cap weighted. In fact, it's different than 80% market cap weighted. So it's still different enough that it's not entirely, certainly not passive, but even enhanced passive, it's a little less than that. That's my statement. So 50 to 80, think of 50 to 80 as the place to be. That's how I'd answer that. But thank you for the question. Very good question.
Yeah. So turning to the charts you had earlier in your presentation about, value versus growth and crowding, do you have any thoughts, which is not the topic that you are talking about today, but, the most common question by far, from investors is about the huge divergence between value and growth that you showed both by factors and with Russell indices. And how are you thinking about that, both, from a crowding perspective, but also do you think that, what would be the catalyst for that to reverse?
That is a great question. And if I knew the answer to that question, I would be in the Forbes 100 today. I'm joking. But
exactly.
I would. But
you
I
don't
guess
know the answer
either. so there we are too. No, I mean, I do believe it has to do with crowding, whether it's smart beta funds. I haven't actually measured it and done a proper job on that, so I can't say with certainty. I do believe there's an inkling there. There's a lot of crowding into this. There's a lot of smart beta coming out. I mean, everyone has a smart beta fund. You go back, when we wrote the book, I remember when we wrote QEPM, no one had a smart beta. It didn't even exist, the word. So
right.
There's a lot of crowding going on for sure. What is the catalyst to reverse it? Now, here's where I really have to say there's probably a lot more people on this phone call that have better answers than I do, okay? Because this is really an idea about active management and forecasting. And so to be very honest with you, I couldn't tell you. I do think it will change. We see this all the time. So do I believe that this will turn around? I do. Whether it's because active managers move away from it or whether the world flips, I do believe. So again, there are better people to answer this question. I'll just remind you of one thing, though. People probably remember 1999, 2000, 2001, 2002, when we had the tech bubble or the internet bubble, whatever they called it, 1.0. And Warren Buffett, who's you could argue is a value investor, was getting slaughtered. I think Warren Buffett's fund was down 43% in 2000. Okay, something like that, a crazy number. And people said, you're too old, you don't have it anymore, it's time to pack the bags, why don't you go watch a Nebraska Cornhusker football game and stop investing? All these things, right? And what happened in 2001, 2002? Warren Buffett's fund came back so strong you can't imagine. He blew it out of the water. Meanwhile, the internet tanked by 80%. So yeah. It usually does revert. But again, there's a lot smarter people that do it for a living, and I would love to give you that answer. But
I know, I would love to know too. All right, we'll have to leave it there. We're getting to the end of the hour, but thank you so much, Professor Chincarini, for joining us today. It was a fantastic presentation, and if you have other questions, you can feel free to email the professor or myself, and we'll get back to you with some answers. Thank you very much for joining us today.
Thank you. Thank you.